Hey, it's Eric Osnes here with Homebridge Financial Home Mortgage with my weekly update on mortgage rates for the week ending July 15th, 2022. Well, once again, it's all about inflation. It started last week with red hot consumer price index, CPI, coming in at 9.1% for the month of June, to be followed this week by the producer price index, PPI, in at a blistering 11.3%. CPI is an indicator of the prices you pay for goods and services. I don't need to tell you about those higher prices, but here are some highlights. Food up 10.4% for the year, energy up 42%, gas up 60%, used cars up 7.1%, and rents up 5.8%. I think actually we're probably closer to about 12% on rents in our local market. PPI measures the prices that manufacturers pay for raw materials and components. This is what's called a leading economic indicator. It reflects the prices that you will be paying for goods in the future, assuming the manufacturer passes the cost of those higher prices along to the consumer, which is pretty likely. Both of these indices are a 12-month rolling average. So what happens is every month, an average, it drops off an average from a year ago and adds the current month's or the prior month's average. That's concerning because, especially with CPI, the stats last summer were pretty benign. So we're replacing a low number with a very high number into the average. If CPI continues at its current trajectory, we could see it up over 10% within the next few months. That's something we haven't seen since I had hair, and since probably the late 1970s. The bond market did not like these numbers, and the probability is growing that the Fed will increase their rates three-quarters of percent to possibly 1% at their next Federal Open Market Committee meeting, FOMC meeting. That's July 26th and 27th. Mortgage rates struggled, ended up the week slightly higher, not as bad as we could have expected. Here are the national averages. Conventional 30-year fixed rate mortgage, 5.77%. 15-year fixed rate conventional, 5.5%, 5.0%. FHA and VA 30-year fixed rates, 5.25%. Jumbo 30-year fixed rates, 4.88%. 5/1 ARMs, 5.4%. We're probably going to see very few adjustable rate mortgage options in the near future. That's because we also have an inverted yield curve. And that means that shorter term securities are actually paying a higher rate than longer term securities, which is a fairly solid, steady indicator that we may be entering into a recession in the near future. So let's talk about some other things here. The headlines are full of news about housing, and it's all doom and gloom. They're talking about the slowing housing market, and some are talking about a crash. But you know what? Our local statistics tell a different story. It is true that that homes are not selling within hours of being listed now, and we're not experiencing 10, 20, 30 bids on every listing and price escalations on every one. But that's mostly because we have more inventory finally. In King County, there are almost 5,000 new listings for homes in June, 1,830 in Snohomish County, 1,954 in Pierce County. And pending sales, which is a sign of housing activity, was also strong, 2,819 in King County last month, 1,263 in Snohomish County, 1,493 in Pierce County. We did see some price reductions in our market, though, for various reasons. Some sellers are still listing their homes at pie in the sky prices, and they're having to kind of come to a little bit of reality after, a few weeks or a month of being on the market. Others are adjusting because, well, maybe their home isn't perfect. It has some deficiencies. It's not as pretty as some of the other listings coming on. You could get away with that when you were the only listing in the neighborhood. But now that there's more inventory out there, there's some right sizing, some adjusting that has to be done with some of those. We're happy to see that increased inventory. It means that buyers have more choices. They don't have to make a desperate play for the only home available in that neighborhood. It also means that a seller may be more inclined to accept an offer at the list price and maybe even pay some closing costs. I've seen a few of those over the last few weeks. But even with more inventory on the market, we're still not in a buyer's market. There's less than 2 months inventory at present. And to really be in what we would call a buyer's market, there needs to be 4 to 6 months of inventory, which is really not likely. So, we're probably more into, let's call it a balanced market, certainly not a buyer's market yet. Given all these statistics, we don't expect house prices to fall. We'll see some adjustments, but it's still a seller's market for all intents and purposes. But these higher mortgage rates we've had this year, and that's really thinned out the number of buyers. There's still buyers for every home out there, just not as many. And with the more inventory, there are some really good opportunities to get finally a good buy on a home. So if you're a savvy home buyer, you should be out there looking, see if you can take advantage of some of these opportunities. I'm always here, happy to help answer all those story problems, help work the numbers. Reach out if I can answer questions or give you financing advice or information. You can call me 206-915-3742. You can also email me, eric@ericismybanker.com, and look for me on social media, Facebook, YouTube. Just look up Eric is my banker. You can subscribe to my weekly update on mortgage rates so you don't miss out on any of the news coming out as we enter some pretty interesting times in the financial world. That's it for me for this week. I hope this is helpful. We'll talk to you next week. Have a great weekend.